Now, lastly, when purchasing, we've got a gift from the federal government, and that's the HST program in Ontario. If you're in an HST province, provincial sales taxes have been eliminated. That means that you get back all of the taxes on your purchased equipment as an input tax credit or a refund. A good example of this is that our firm expanded substantially, unfortunately, right before the HST was implemented. We purchased $300,000 of new equipment, computers, etc., and had to pay $24,000 in provincial sales tax. Had we been able to delay that expansion by just 9 months, that amount would have been saved. So when you're making your purchase decisions, you really want to remember that HST should not be part of the decision. It's a completely refundable amount.
So David, can you quickly walk me through this? So, you know, when customers purchase our system, when they actually make an outright purchase, you know, we see a few elements of it. There's the monthly costs, which I'm assuming are going to be treated differently, just the monthly service costs. There's an equipment cost. There is an installation cost, and there is a training cost. So that breakdown you're saying is critical in terms of how customers should view their taxation?
Absolutely, because their training cost will be, two of those four components will be deductible when they're paid. Your training cost and your
installation?
No, your training costs and your monthly fees are going to be deductible. However, the installation cost has to be added to the cost of the purchase.
Okay.
But the good news on that, and we're going to see that in a chart shortly, is that with the rate of only 55% write-off, most of that will be recoverable quite quickly and in the first 2 years. Now, if customers are considering as an option leasing equipment, some important points. The first point is that lease costs are fully deductible, and there's an implied interest rate in that lease. So if you're going out and you're borrowing money to purchase, there's an interest cost. When you're leasing, there's an interest cost, and you need to know what it is. So when you're looking at a lease, don't just look at the dollar value. Break the lease down and understand its components, just as you're going to break the purchase down and understand the components. Now, for leasing, depending on the size of company that you are, the accounting treatment can be very different for tax treatment. And this is very important because if you are a larger company and you're reporting under certain rules, you may have to show a lease as being debt on your financial statement. That can impact your banking ratios. So again, understand all the facts before you enter into a purchase or a lease decision. But for many companies, critical point is that leasing can be off-balance sheet financing. You're not necessarily having to go to the bank, and you're not necessarily having to use up borrowing capacity.
That's good.
So very quickly, I've put out a chart with tax rates, assuming a $10,000 investment by either a larger corporation or a smaller corporation purchasing equipment. So in the large corporation is a company that's not defined as a small business corporation in Canada, and it has an average tax rate of 32.5%. And you can see that if you purchase $10,000 in technology equipment, you'll recover the cost entirely in 5 years. Excuse me, you'll recover the tax on that amount entirely in 5 years, with the significant portion of it recovered in the first 2 years. Similarly, if you're a small business corporation, you've got this lovely tax rate of only 16.5% on your first $500,000 of income, and you're going to recover most of that in the first 2 years. So main point is that the tax savings on purchasing have a bigger impact in the first 2 years. Now, if we look at leasing, the payments are spread out equally, usually over the term of the lease. And so, while the savings are exactly the same on a 5-year lease versus purchasing, the savings are not as great in the first 2. So, the so if you're really looking at this closely and you're breaking out all of your components, purchasing will give you a bigger return for tax purposes than leasing will in the first 2 years and less so in the last 3.
Now,
So
David, can I? Sorry?
Yeah, go ahead.
I'm going to throw out one at you, and I don't know if we've discussed it, so but you're a pretty smart guy. So we provide leasing options to our customers, and we provide, of course, purchasing options. We have a third model where customers aren't required to make any capital purchase whatsoever for equipment, for installation, for training. It's strictly a monthly fee. Certainly at the end of the contract term, they don't own any equipment or anything like that. But it's like an evergreen model. How would that fit in here relative to a lease or a purchase? I'm not sure where that model would fit.
Well, yeah, it's a great question. And as long as at the end of the agreement with you, the customer doesn't have the option to buy the equipment for a nominal fee, then this would be treated as a straightforward service cost and be fully deductible each year.
Okay.
And it could be very, very attractive for companies who don't want to have to use up their borrowing capacity. Could also be very attractive for companies who may not qualify for straightforward financing. There may be growth companies. They don't have as strong financial statements at this point, and that can be a very strong option for them.
Great, thank you.
So moving on, just to wrap that up, the leasing versus purchasing decision. Long-term savings for leased equipment are pretty much the same as purchased equipment, but you're going to get a greater bang for the buck up front on purchasing than you are on leasing. However, leasing is probably more attractive to many companies simply because they're not having to use up their borrowing capacities. You do have to look at interest rates, though, because often in leases, their interest rates may be higher or may not be as clear. So I'm just going to move on to the second point that I wanted to bring today, and that's that technology allows us, again, to make strategic decisions. So with new technologies, it's quite possible that employers may want to say, look, my employees are happier working from home. Maybe they're in Toronto, as mentioned, and don't want to deal with commuting costs, etc. And they'd be very happy working from the so-called virtual office. I mean, I work with my iPhone. Sometimes I feel like throwing it under the tires of my car because it puts us in touch with people constantly. But that has really changed the way we run our lives. Having a VoIP system with that type of twinning option that you mentioned gives people the ability to work from home, and nobody knows where this employee really is when they're contacting them. Similarly, you brought up the point that it makes your company look larger. I've been dealing with a supplier of mine for about 5 years, and I've always thought they were a fairly large company. And I only realized about 3 months ago that there are actually 5 separate people in 5 separate homes using a VoIP system. And when I call them and I speak to Joe and I say, hey, I would like to speak to Harry, they just say, sure, hold on a second. Without me knowing it, they're actually calling Harry's house and putting it online. I think that's kind of cool. So what I just want to touch quickly is the taxation issues around having employees who are not working in a normal office place. The other point to quickly bring up as well is that some certain studies have shown that the average cost of an employee's overhead in a typical office space is $24,000 a year. In other words, that employee is costing the company $24,000 before $1 of salary is paid. If you can move that employee out of that fixed workplace and into their home, that's a considerable savings. So if employees are working from home, they may have the advantage to deduct home office costs. And I'd just like to point out, if you're going to go down that road, always have a written employment contract with the employee. That's critical. The employee is then allowed to deduct at least certain employment costs, which I'll cover a little bit later on, but they may also be able to deduct other costs like their vehicle expenses, office expenses, etc. One
David?
little tech, yes.
Oh, sorry.
Yeah.
Sorry to bother you, but the T2200, and I think you might mention it later on, is that not an implicit employment contract, or do you need something more explicit than that?
Great question. The T2200 is a form required by Canada Revenue Agency to be issued by the employer, and the employee has to have it when they prepare their tax return. There's an argument that can be made that it's an implicit employment contract. However, the Income Tax Act does say that to be able to deduct these expenses, they must be subject to a written contract. I wouldn't put at risk my employee's ability to deduct these costs by relying solely on the T2200 form. And remember, the T2200 is a form developed by Canada Revenue Agency. You may not want to be relying on Canada Revenue Agency.
Are you speaking from experience?
Just a little. Just a little.
This call is being recorded. Exactly.
Precisely. So moving on, if employees are working from home, they can deduct various costs. The costs are quite limited, though, for regular employees. And we have to remember that regular employees must keep all of their receipts for all of their expenses. As you mentioned, they must have the T2200. They can deduct various costs, but there are limitations for employees. Employees can't deduct mortgage interest, for example. They are allowed to deduct rent, oddly enough, but not mortgage interest. So employees have to be a little bit careful, and employers, if they're going to ask their employees to work from home, should be careful not to make promises to their employees that aren't accurate. And I would recommend carefully checking the tax regulations with your accountant before advising employees what they can do. That leads us to some other possible costs, though. The employee, as I mentioned before, might need to travel. Now, if they're working from home, traveling to the office is not an allowable deduction. On the other hand, traveling to the client site is, or maybe just traveling to go to Staples to buy some supplies that they need to use in the home office. So this gives the employee a lot of options to write off certain costs, might make them a happier employee. Now, this leads us to the last slide and an important point. Again, we come back to strategy. I'm not recommending that you fire all your employees and turn them into self-employed contractors, but it's something to give some consideration that you might want to restructure a little bit if people aren't physically working in the office. Subject to some complex rules, again, don't do this without a parachute. Get professional advice. But self-employed individuals who were formerly employees or would normally be employees might be able to claim considerably greater write-offs. This might be very attractive to the employee, or to the, I should say, self-employed contractor, and it's only made possible because of the technology allows it. They can work from home, they're not being provided an office, maybe they have to provide their own computer, etc. And with those extra write-offs, your salary costs may not have to be as high to maintain the same level of service for your clients. So that pretty much wraps up my side, and just open up to any remaining questions.